You know how everyone talks about having life insurance, but barely anybody actually checks what kind they have, or if it even works when it matters. Today, we're diving into something that might surprise a lot of people, because there's a good chance the life insurance you think protects your family doesn't. And the problem? Most people don't even know it until it's too late. Millions of people rely on the life insurance they get through work. It feels simple, automatic, and free or cheap. What's not to like, right? But here's the thing. Employer life insurance is often temporary, tiny, and unreliable when life starts changing. People switch jobs, get laid off, retire, get sick, and suddenly that coverage just evaporates. Meanwhile, the people who depend on you still need financial support. So today, let's look at why employer life insurance alone can leave families unprotected, and what to consider before assuming that workplace coverage is enough. Before we jump in, if you enjoy content about everyday money topics, feel free to like the video to support the channel and subscribe for more financial conversations. Alright, let's get into it. We'll explore a series of points people might want to consider before leaning solely on employer-based coverage. Sign number 1. Employer life insurance usually isn't portable. A lot of workplace life insurance disappears the moment someone leaves their job. Involuntary, voluntary, or retirement, whatever the reason. When the employment ends, so does the coverage. It can feel strange because people assume that once they have it, it's theirs. But it's really the employer's benefit, not yours. This means the safety net families expect could vanish overnight. Life changes constantly. New jobs, layoffs, career shifts. And unfortunately, life insurance doesn't travel with you the same way your skills do. Some companies claim you can convert the policy, but that usually means paying significantly more, sometimes dramatically more, especially if you're older or have health issues. So people might be relying on a benefit that's temporary without realizing how temporary it actually is. That's the reality many families only discover after it's gone. Sign number 2. The coverage amount is often too small. Employer coverage is usually formula-based, maybe one-time salary, sometimes two. So if someone earns $60,000 a year, they might have $60,000 or $120,000 of insurance. But when you think about mortgage, debts, kids, day-to-day living, college expenses, that amount doesn't go as far as people imagine. For many families, that payout might only replace income for a year, maybe less. After that, they're right back where they started, except now someone is missing. When a household loses an income, it's not just the money that disappears, it's stability, it's options. It's time to grieve without being financially crushed. Employer life insurance often can't do that alone. It's a starter, not a solution. Sign number 3. It's not customized to your situation. Life changes. Maybe someone gets married, buys a home, has kids, starts a business, or takes care of aging parents. Workplace coverage doesn't adapt to personal life stages. It's a one-size-fits-all approach. Everyone gets the same basic formula. Meanwhile, individual needs vary dramatically. A single renter and a married parent of 3 are unlikely to need the same amount of protection. Yet employer life insurance treats them the same. And because people aren't designing it themselves, most never stop to ask, does this amount actually make sense for my situation? Often the answer is no. Sign number 4. Your employer controls the policy, not you. If someone owns their own life insurance policy, it's theirs. They can take it anywhere, keep it during unemployment, keep it during retirement, and maintain it even if their health changes. But with employer coverage, the employer decides how much coverage is offered, which insurer they use, whether benefits change year to year. If the company changes providers, reduces benefits, or restructures, there's nothing the employee can do about it. Imagine your coverage shrinking right when your needs grow. That happens more often than you'd think. Sign number 5. Job changes are frequent, but coverage doesn't follow. The average person switches jobs many times throughout their career. Some stay long-term, but many don't. So even if someone has great coverage right now, it might not still be there 2 years from now. Think about someone who leaves a job unexpectedly. Maybe they got a better offer. Maybe they felt burned out. Maybe the company had layoffs. Whatever the reason, the insurance usually stays behind. That means they're suddenly uninsured or underinsured until they find something else. And if someone's health has changed since they first got that employer coverage, getting new personal coverage could be more expensive, or maybe not even possible. Sign number 6. Employer coverage doesn't care about your health. At first, one reason people like workplace insurance is that it usually requires no medical exam. It's automatic. That's actually a great perk. But here's the catch. Because it's so easy, many rely on it instead of getting their own coverage while they're young and healthy. Time passes, a medical diagnosis appears, or age increases, and suddenly getting personal life insurance becomes harder or more expensive. Employer insurance can give someone a false sense of security, so they procrastinate getting real coverage until it's too late. Sign number 7. Losing coverage later in life is common. One of the most difficult situations is when someone reaches retirement age. Employer coverage often shrinks dramatically or disappears after decades of working. At the exact moment someone stops earning income, their life insurance becomes limited or completely gone. Now imagine someone who wants coverage at age 65 or 70. Their rates are higher, their health may have changed, and sometimes it's too late to purchase affordable coverage. It's not that employer benefits are bad, they're just not designed to last beyond employment. Sign number 8. Some employer policies don't pay in certain situations. This doesn't happen everywhere, but some group policies have exclusions. Maybe someone wasn't officially enrolled. Maybe they didn't fill out a required form. Maybe there's fine print for certain causes of death, and the beneficiary discovers this at the worst possible time. When people buy their own coverage, the terms are usually clearer. But with employer coverage, employees commonly never read the details, so surprises are more likely. Sign number 9. Supplemental coverage through work may still be limited. Some workplaces let employees buy extra insurance. That sounds great, but supplemental workplace coverage often still depends on being employed. Leave the job and the policy disappears, and sometimes there's underwriting for the extra portion. So people may not get the amount they want anyway. Again, there's nothing wrong with having it. It just shouldn't be the only plan. Sign number 10. Personal coverage grows with you. When someone owns their own policy, they control it. It's not tied to a job, a salary, or a company decision. They can increase it later, or add additional policies when life changes. People get married, have children, buy homes, start businesses, take care of family members. Their insurance can evolve with them, but only if they own it. Employer coverage just sits there unchanged, even when life doesn't. Sign number 11. Your employer benefit is not a financial plan. Employer coverage is often treated like a full plan, but it's more of a perk. A real financial plan looks at needs, debts, family size, long-term obligations, future goals. Employer coverage doesn't consider any of that. It's just a line item on a benefits package, not a personalized solution. Relying on it alone could leave massive financial gaps. Sign number 12. If you become disabled, you might lose coverage. Some people assume workplace insurance helps if they get seriously sick or can't work. However, losing employment due to health issues could also mean losing insurance coverage. So at the exact time someone might want their family covered the most, the coverage may vanish. It's a harsh reality. Sign number 13. Employer coverage isn't always a guarantee. Companies change, policies change, benefits change. Just because something exists today doesn't mean it will still exist tomorrow. Many employees find out only when open enrollment comes around and the benefits look different or cost more. Sign number 14. A career change can suddenly expose the gap. Imagine someone moves from a big company with great benefits to a small startup with none. They just went from being covered to having nothing. And if that person developed health issues during the previous job, getting new coverage might be tough. That's why relying only on employer coverage is risky, because life doesn't always move in straight lines. Sign number 15. Peace of mind is about stability. Employer insurance feels nice, but personal insurance adds stability. There's something comforting in knowing this coverage is mine. Nobody can take it away. I don't have to requalify for it. I don't need to worry about switching jobs. It's just there. That feeling alone can be worth it. So, we covered a lot. Employer life insurance can be a helpful perk. It's better than nothing. But there are some big limitations that people might want to think about. It usually doesn't follow you when you leave your job. The payout amount is often too small. It doesn't adjust to your personal needs. Your employer controls it. Health changes can make replacing it harder. Retirement often means losing it. It's not a full financial plan. It's not that employer coverage is bad. It just wasn't designed to be a family's main or only safety net. Many people consider having personal coverage in addition to workplace insurance, just so their protection doesn't disappear when life shifts. If you made it this far, thank you for hanging out. I'm curious, do you think most people know that their employer's life insurance won't follow them if they leave their job? Drop your thoughts in the comments. If you found this helpful, feel free to subscribe for more financial conversations and tap the like button so others can discover this too. Thanks for watching and take care.